Professor Levitin, as you know, my colleagues on the other side of the aisle have had a string of hearings, really a relentless campaign to weaken Dodd-Frank, and they claim that it's too costly for financial institutions. But this just looks at one side of the equation, the cost to financial institutions, and I would look also and take into account the cost to consumers of not having adequate consumer protections in place. They say this downturn cost $16 trillion of household wealth, large unemployment. We were shedding 700 jobs a month, 800 jobs a month. Can you comment on the long-term cost to consumers, and I'd say the overall economy, of not adequately regulating financial products and services? It's been said that our regulation didn't keep up with the innovation, and experts testified before this committee and others that this was the first financial crisis in history that could have been prevented with better financial regulation of risky products and risk-taking. So your comments, please.
The financial crisis was completely preventable and would have been prevented if the Dodd-Frank Act's mortgage regulations had been in place. The scale of the financial destruction and particularly household wealth, and especially for communities of color, as a result of imprudent mortgage lending, not all of which was done through securitization, but a great deal of which was also financed through bank portfolio lending, particularly Countrywide, Wachovia, and Wells Fargo and Washington Mutual all had large portfolio lending operations. All of that caused tremendous loss of wealth for American families. I think it's also important to note that sometimes regulations actually not only protect consumers, but put money back in their pockets. The Credit Card Act, of which you were one of the authors, has been found to actually have saved consumers billions of dollars. Yet we don't hear
over $10 billion a year.
I thought you would have the number.
That's a stimulus package that we gave the American people.
But we don't hear a peep about that when regulation is discussed. Instead, it's regulation is only looked at in terms of compliance costs without seeing the benefits, whether it's financial stability or clear pocketbook savings for American families.
So just to emphasize, do you think these costs outweigh the incremental cost of compliance to financial institutions? And I would say the Credit Card Holders' Bill of Rights helped institutions. It hasn't hurt their bottom line. It cut out unfair, deceptive practices so that more people have trust in their services.
There are costs to doing business, and there's not an inherent right to get to operate a bank. It requires a charter, and you have to be able to be competitive. And part of being competitive is being able to comply with regulations, particularly regulations that are necessary for preserving certain minimum standards within the industry.
Okay. I also, in your testimony, you noted that the CFPB has already granted community banks significant regulatory relief. And in your opinion, do you think the CFPB has been sufficiently responsive to the concerns of community banks?
Generally, I believe it has been. There are some places where one might dicker with the CFPB about a particular threshold for exemptions. So, for example, on the remittances rule, should the number of remittances be 100 per year or 200? I think there are reasonable differences of opinion, but directionally, I think the CFPB has made considered judgments, and it's trying to balance important considerations, not just about small financial institutions, but about consumers.
And you raised another important point in your testimony, that the oversight of the non-bank mortgage servicing industry is uncoordinated, to use your words, and that, quote, until and unless housing finance reform is resolved, the industry will remain in flux and in need of reform. Given the uncertainty surrounding housing finance reform, what alternatives would you suggest concerning coordination across the relevant regulators of non-bank mortgage servicers that could begin to address the reforms that you believe would improve improve the overall economy and consumer experience.
The gentlelady's time has expired, so a quick answer, please.
Obviously, there are tremendous difficulties with getting any kind of legislation passed on housing finance reform. Until and unless that happens, I think that there needs to be a formal coordination mechanism among financial regulators on mortgage servicing in order to try and stabilize the servicing industry.
The chair now recognizes the gentleman